Happy morning, people. So we'll be starting with Ind AS 1 today, called Presentation of Financial Statements, right? So this is more like now which company. We have now covered almost all the Ind AS, right? Now we are getting into which company should actually follow Ind AS, right? So those sort of frameworks, etc., is going to be studied in. Are we going to study in Ind AS 1? Quite an easy topic, but again a floater topic, easily can be incorporated in any other multidisciplinary case studies as well. Okay, so we'll see this. Okay, first one, in India, right? India has not copy pasted IFRS. So Ind AS ka base is IFRS. That's the base. Now India, we have not copy pasted IFRS, meaning as it is, we have not taken and called it as Ind AS. We have taken IFRS. Wherever required, we have made some changes. That's the reason we say India has converged to IFRS. We have converged to IFRS means we have used that IFRS as a base and made some changes. That's the reason we don't call it as IFRS, we call it as Ind AS, right? That's a new name given basically. But 90, you could say almost 99% IFRS and Ind AS are same. There may be only 2 or 3 areas where there is some differences between Ind AS and IFRS, and that too all small ones. Right? Otherwise, more or less will sync up. Fine. That is one. Sir, who issued Ind AS in India? Basically, Accounting Standards Board of India has taken the responsibility of framing the standard in consultation with NEFRA, but credit is taken by a government. Right? We will do the work and give the documents to government, and government finally has published, and they are taking the credit for it. Fine. But yes, preparation is taken, lead is taken by us, so that's definitely a proud moment for us. Right, so that's about the process, who set and etc. Okay, now move on to the next. There is something called carve outs and carve in. Carve outs means differences between IFRS and Ind AS. If Ind AS says go left, IFRS says go right, then that we call it as what? Carve out. The differences between Ind AS and IFRS, we call it as carve outs. There may be like 3 to 4 carve outs at best currently. Okay, fine. Carve in means restrictions. There is also something not called carve in. Carve in means restrictions. Let's say IFRS tells inventories can be valued using 3 methods. IFRS says inventory can be valued under 3 methods. Ind AS says you can value only under 2 methods. And these two are already included here also. IFRS is giving one extra method. Ind AS is not suggesting that one extra method. So that restriction in option, we call it as what? Carve in. Carve in means not differences, some extra things, whatever you're doing between Ind AS and IFRS, we call it as carve in. Got the difference between carve in and carve out? They are not that very important, but just say. Okay. All right. The next thing, which is actually quite important from this particular topic, is from what day should the company apply Ind AS and which all companies will apply Ind AS. Okay. Now, first, Ind AS was introduced in 2 phases. Because Ind AS was a big transition. We know that by now that there are a lot of differences between AS and Ind AS, right? So since it was a major difference, they did not impose Ind AS on the company straight away, right? They implemented in 2 phases called phase 1, phase 2. Phase 1 ka implementation was 1st April 2016 on a mandatory basis. Okay, if a company falls under phase 1 category, then mandatorily they need to apply Ind AS from 1st April 2016 with obviously comparative financial statement, date of transition, opening Ind AS balance sheet, all that what we studied in Ind AS 101 will hold good. Got it? If you are not under phase 1, then few companies, if companies does not fulfill phase 1 ka category, then they may come to phase 2. If you are a phase 2 company, then you will apply Ind AS from 1st April 2017 on a mandatory basis. Now, which company will come under phase 1, which company will come under phase 2? That's the thing. Okay. And also, people, by the way, this video will upload on the YouTube. There is an amendment. Okay. In this chapter, there is a small amendment which has happened. That amendment video we have separately recorded and it's available on YouTube, right? But this video also I'll post it. There are one question, one concept, there is an amendment. Maybe I'll cover this, and in about half an hour's time, I'll cover that amendment also, maybe first. Those YouTube audience, if you want, you can accordingly find it. Okay, I'll just cover this and come to that amendment. It's a very small amendment, and that amendment video is also available separately, like 3-4 months back only we have uploaded. Just in case you missed, again this video also will upload for your reference. Okay, now As I said, Ind AS ka applicability was made for companies under two phases, phase 1 and phase 2. Phase 1 ka implementation date is what? 1st April 2016. You need to remember which phase, which date. This may be one of the potential questions that can come from this particular topic. Phase 2 ka application date is 1st April 2017. Now, which company will come under phase 1? Very simple. If you are a company, whether you are listed, unlisted, doesn't matter. If your net worth of your company is 500 crores or more, if the net worth of your company is 500 crores or more, you automatically come under what category? Phase 1. Whether you are listed, unlisted, doesn't matter. They have split it, but it really doesn't matter. Listed companies whose net worth is 500 crores or more also will come under phase 1. Unlisted company whose net worth is 500 crores or more also will come under phase 1. So basically easy, we'll remember it. If company ka net worth is 500 crores or more, they automatically come under phase 1. Comfortable? Okay. If you don't come under, maybe let's say a particular company ka net worth is only 300 crores. A particular company ka net worth is only 300 crores. Did they satisfy phase 1 ka criteria? No, they failed. Now there may be a possibility you might get covered under phase 2. Phase 2 means all listed companies which did not get covered under phase 1 will fall under phase 2. So basically, in the nutshell is all listed company have to compulsorily follow Ind AS only, irrespective of their net worth. Their net worth is positive, negative, 1000 crore, 1 crore, 100 crore, doesn't really matter. If you are a listed company, compulsorily you will apply Ind AS. If your net worth is 500 crores or more, you come under phase 1. Right? If you don't satisfy phase 1 ka criteria, automatically you come under phase 2. Understood? Everybody? So what about unlisted company? What was the earlier limit? 500 crore. Half of that. What is 500 crore ka half? 250 crore. So if an unlisted company ka net worth is 250 crores or more but less than 500. If an unlisted company ka net worth is 250 crores or more but less than 500. They come under which category? Phase 2. So what if unlisted company ka net worth is below 250 crore? Such companies will follow accounting standards. Got it? So don't have to worry. Most of the companies whom you go and work for will be applying Ind AS. Right? But if you are doing your own practice, then you might get some small companies also who are following AS. Some big companies who are following Ind AS also. So for you, you need to know both. If you're going for industry, most probably you will work for an Ind AS based company. This is the limit. Got it? How to calculate net worth is the next thing. I'll tell you what is net worth and all that. Are we good with this so far? One step at a time. And previously I had mentioned you, if you remember, Ind AS is a family affair. What affair? Family affair. Meaning if you are applying Ind AS, if you are a company and applying Ind AS, your parent, your subsidiary, your associate, your joint venture, all of them also have to apply Ind AS. If X Limited is applying Ind AS means X ka parent P Limited will also have to apply Ind AS. If X has a subsidiary called Y, they also have to apply Ind AS. If X has an associate or a joint venture, they also have to apply Ind AS. So this is the family affair. That's what is written in here. Got it, everybody? Any problem? Same limit is written here also. Doesn't really matter. See, if X Limited crosses net worth limit, then for their parent, their subsidiary, associate, joint venture, you won't check net worth. The net worth may be 1 crore, 100 crore, 500 crore, 0, negative, doesn't matter. If one company is applying Ind AS means other company by default will apply Ind AS whether they satisfy net worth limit or not. That doesn't really matter. That's a good question. Hope you got it. No. Ind AS. It is not consolidation, right? Ind AS is a separate. Ind AS 1 is a separate standard. It is not applicable for consolidation. We are talking about SFS only here. Okay. In separate financial statement only, the moment you satisfy net worth limit, automatically you will have to shift from AS to Ind AS by applying Ind AS 101 ka first time adoption principle in SFS only. In CFS also, you'll have to do the same thing. Once Ind AS is applicable, SFS, CFS, both you'll have to prepare as per Ind AS. Anything more?
We saw that subsidiaries
5 minutes. He's saying, sir, yesterday you did one problem where one company was applying Ind AS this year. Next year they are applying the Ind AS. That I told you specifically can come in case of NBFC. Because this is for normal company. This limit, now that was about my next point. You may be little ahead, you went off. He stole my limelight. Chai, I don't like him. Yeah, all right. Sir, this phase 1, phase 2 limit now is applicable for normal company. Meaning, if you are a banking company, if you are an insurance company, if you are an NBFC, this is not the limit. If you are a company other than banks, insurance, and NBFC, this is the limit for you. For banks, insurance, NBFC, there are separate limits. We'll talk about that in a bit. We'll get there. This is for a normal company. Understood? Fine. I'll come to your doubt once again, also in case it is not sorted. Everybody good with this so far? This is one. Okay, call it out once again for me. What is it? If you are a company who is not a bank, which is not a insurance company, which is not a NBFC, then when you should apply Ind AS? Either you'll come under phase 1 or you'll come under phase 2. For you to come under phase 1, net worth should be 500 crores or more. Whether you are listed, unlisted, doesn't matter. Right? Then phase 2. Phase 2 means if you are a listed company who did not get covered under phase 1, then you automatically get covered under phase 2. If you are an unlisted company not covered under phase 1, then if your net worth is half of the above limit, what is that half? 500? 250. Unlisted company whose net worth is 250 crores or more but less than 500 will fall under phase 2. And if your company is applying Ind AS, then your parent, your subsidiary, your associate, your joint venture, they also have to compulsorily apply Ind AS. No choice, compulsory. Okay. And one more thing, when we say listed, right? Here the standard is a little more stringent. You can be already listed or you could be in the process of listing. The words here is you are already listed or you are in the process of listing your share, meaning you have filed some papers with SEBI for listing arrangement. Then also you'll come under this only. Then also you'll be considered as listed company only. Either you are already listed in the stock exchange or you are in the process of listed. Both are given the same weightage here. Okay. Whether you are listed in India or abroad, doesn't matter. Both are covered over here. Okay. So that means what is the provision over here? Either you are already listed or you are in the process of listing your shares or securities in India or abroad. All are considered as listed for application of phase 1 and phase 2 purpose. Done, Aji? Okay, so if you are in the process of listing also, then means what? Either you will come under phase 1 or you will automatically come under phase 2 because you are as good as considered as listed for Ind AS applicability purpose. Okay, so can company, if the net worth is not, the net worth limit is not satisfied, but can they voluntarily apply Ind AS, sir? It's permitted, sir. Right, voluntary application. Even if these net worth limit are not satisfied, let's say company, unlisted company, net worth is only 500 crore. There is one private limited company or an unlisted company whose net worth is how much? 50 crore. That means they don't come under phase 1 nor they come under phase 2. But if they voluntarily still want to apply Ind AS, acceptable. Fine, that is one. And Ind AS is permanent affair. Husband-wife relationship. Or maybe I think these days husband-wife relationship is breaking. Okay, let's take it as parents-wala relationship. That's more safer, no? Right? Once Ind AS is applicable, then permanently Ind AS for you. You can't say this year my net worth is 500 crore, so I'll apply Ind AS. Next year my net worth became 50 crore, I'll shift to AS. Once Ind AS is applicable means permanently Ind AS for all the future years. Every year you don't have to check net worth limit. Check only once. If it is satisfied means then permanently Ind AS for you. Subsequently, if net worth increases, net worth reduces, it really doesn't matter. Once Ind AS comes, throughout Ind AS. That way. Fine, people. Good. Okay, now we have some questions also, some doubts of yours you might have with respect to dates and when to check the net worth and all. It will sort it. One by one, we'll take it. Yeah. But phase 1, phase 2 ka dates, call it out for me. What is phase 1 ka date? For a normal companies, yeah. 1st April 2016 is phase 1 ka date. Phase 2 ka 1st April 2017. You need to remember that, right? Because those are one type of question that can come from this particular Ind AS. Okay, next is net worth. How to calculate net worth, sir? Very simple. Take your equity, take your paid up share capital. Currently you are applying AS only, no? In AS we call it as share capital, right? So take your paid up equity share capital. Add all the reserves and surplus which are created out of profits. Meaning P&L, general reserve, basically any free reserve, right? Or we believe that. Any reserve which is created out of profits, add. Okay, fine. If you have any securities premium, you add. If you have any accumulated losses, deferred revenue expenditure, miscellaneous expenditure, you minus. Because all this affects what? Deferred revenue expenditure also eventually will go where? To P&L only, no? So because of this, if you transfer deferred revenue expenditure or miscellaneous expenditure to P&L, P&L balance will reduce. Hence you minus. So if P&L has a profit balance, you add. Loss balance means if P&L has debit balance, meaning if it's a loss-making company, then you will minus. Because this reserve will have not a credit balance but a debit balance. By doing this, you get something called net worth. This is how they have suggested you calculate the net worth. How do you calculate? Again, this one you need to remember, they will not give. So how do you calculate net worth here again? Take up your paid up share capital. Then add all the reserves which are created out of profits, like your P&L, general reserve, etc., etc. Then security premium, if it is there, you add. If you have accumulated losses, meaning if P&L has debit balance, minus. If you have deferred revenue expenditure or miscellaneous expenditure by chance, usually all this will be transferred to SPL already. By chance, if it is given, you minus. By doing this, you get something called what, sir? Net worth. This is the way to calculate net worth. One point is this. We'll apply in the problem also, right? It's there. You don't have to write it. It's the first line only. Here it is there. They have given in sentence. So I just gave it an equation. That's the only difference. Okay. This is one. Next, sir, which day we need to check the net worth, sir? Phase 1, what is the application date? 1st April 2016. 2 years before that. What is 2 years before that? 1st April 2014. Sir, when you are checking the limit, you use balance sheet. Balance sheet you prepare on 1st April or 31st March. So go 2 years back and take 31st March ka date. So you will check the net worth limit on what? 31st March 2014. So first time you will calculate net worth, right, on 31st March 2014. If that net worth is 500 crores or more, automatically you come under phase 1. Got it, everybody? This is the thing. Okay. For you to come under phase 1, first time you check the net worth on 31st March 2014. Basically 2 years before phase 1 ka application date. But take balance sheet date of 31st March. Don't take 1st April 2014. Done, Aji. That means only once you will check, sir. That's all, sir. No. For you to come under phase 1, first time you will check the net worth limit on 31st March 2014. Okay. Then what? Suppose company got registered only on 2020. A company got incorporated only in 1st April 2020, right? Possible, no? A company can get formed later also. Right? So, it's not that like you check the net worth limit only once. If you want to call yourself under phase 1 company and apply Ind AS from 1st April 2016, that time they had told calculate net worth on 31st March 2014. If it is satisfied, you come under phase 1 like that. Suppose you are an existing company, but your net worth is only 50 crore. Okay, your net worth is only 50 crore from 31st March 14, 15, 16, everywhere. But let's say on 31st March 2017, at 31st March 2017, right, your net worth crossed 250 crore. Net worth crossed 250 crore. It's an unlisted company. Unlisted company to come under phase 1, their net worth should be more than 500 crore. So they will not come under phase 1. But if, let's say, unlisted company ka net worth is 250 crores or more, even they need to apply Ind AS. When did their net worth satisfy? 31st March 2017. Immediately next day onwards, you need to start applying Ind AS. Next day means what? From 1st April 2017 onwards, Ind AS is applicable. So for 2017-18, you need to prepare financial statement as per Ind AS, but along with comparative financial statement. And that means your date of transition will be beginning of previous year, which is 1st April 2016, like this. Understood? Suppose, okay, once again, you tell me, suppose net worth limit got satisfied on 31st March 2020, then you will have to apply Ind AS. Ind AS applies on what date? The very next day, which is 1st April 2020. That means you need to prepare, first time you need to apply Ind AS from 2021 year, along with previous year ka comparatives. Previous year ka comparatives will be 2019-20. That means first beginning of previous year, 1st April 2019 will be your date of transition for Ind AS 101 application purpose. This is so it is not a one-time check. I don't know, people. If you don't satisfy Ind AS means every year. If you don't satisfy Ind AS means every year you need to check the net worth. If you have already become listed, then net worth limit is irrelevant. Automatically you need to start applying Ind AS. But if you are unlisted company and if your net worth crosses 250 crores or more, immediately from next day onwards, you need to start applying Ind AS. Got it? Everybody? Online, can you give me a confirmation on this? So far, did we get? Okay, some thumbs up. So I'll take that this as a thumbs up for everybody. All good. Okay, move on to the next then. Look at this question. Now this question targets more about your net worth ka calculation. Okay. So we have a small questions here, 7, 8. All of them will target small doubts you might have or you might get later on. Okay. So if you have any doubt, just wait for maybe 6 to 7 questions. They're all like some clarification and they have made it as a question. So most of your doubts, whatever you have, might get clarified. If it still remains, after those 6, 7 questions, ask me. Okay, come to question number 1. All of you. Updating anything? Done, no problem. Okay, sir. All right. Question number 1. Following is a snapshot of audited balance sheet of a particular company on 31st March 2014. Okay. Company shares are listed in the Bombay Stock Exchange. So this is a listed company. Listed companies means either they'll come under phase 1 or maybe they'll come under phase 2. Right? Even if they don't come under phase 1, I mean, obviously, if they don't come under phase 1, they automatically come under phase 2. Okay, here check. So what you need to do is, as per the roadmap, which phase does this company fall into? Sir, phase is dependent on the net worth. If your net worth is 500 crores or more, whether you are listed or unlisted, you come under phase 1. Then, if a listed company doesn't get covered under phase 1, they automatically get covered under phase 2. So here, let's calculate the net worth. How do you calculate net worth? Will you take equity share capital? Yes. Take your calculator, add. Will you take security premium? Yes. General reserve? Yes. All the reserves which are created out of profit you need to create. So general reserve, add. Is revaluation reserve created out of P&L? No. Revaluation reserve comes due to asset valued under fair value model. So this is not created out of profit. Leave that. P&L is coming on the liability side, means P&L has credit balance. So add. If P&L has debit balance, minus. Here it has credit balance, so add. Then no accumulated losses. Any deferred revenue expenditure, miscellaneous expenditure is there. Yeah, miscellaneous expenditure, deferred revenue expenditure not written off is 80. Minus that. How much are you getting? Your net worth is 505 crore, correct? Sir, if your net worth is 505 crore, that too on 31st March 2014. On 31st March 2014, if your net worth is 505 crore, which phase do you come under? You come under the phase 1 category. You come under phase 1. If it is phase 1, what is the Ind AS application date? 1st April 2016. So this company has to apply from 1st April 2016. Done now. Next, will your answer change if A is an unlisted company? If A is unlisted company, answer will change. No, since their net worth is more than 500 crore, even unlisted company whose net worth is more than 500 crore will come under phase 1. Answer is still the same. In case 2 also, you come under phase 1. Ind AS is applicable from the same date. No change. That's all this problem. Move on. Okay. Right. Second, next question. Let's say in the above question, they've taken the above question and done some modification here. Let's say in the above question, balance sheet in P&L is negative 375 crore. Now they are saying P&L does not have credit balance. It has a debit balance of 375 crore. Now recalculate net worth. Share capital 160, add. Security premium 200, add. General reserve 150, add. Revaluation reserve is not created out of P&L. Ignore. P&L they are saying is not 75. It is 375 debit balance. That means you minus 375. Instead of 75, they ask us to assume 375 negative. So minus that. Okay. And also reduce minus 80 for miscellaneous expenditure. Minus 80 you do. How much are you getting? In that case, the net worth will be 55 crore. Agreed? If you are a 55 crore net worth company, but you are listed, you will come under phase 1 or phase 2? Listed companies who don't get covered under phase 1 automatically fall under phase 2. That means you will come under phase 2. If you are a phase 2 means you will apply Ind AS from 1st April 2017 onwards. Any problem? Okay. Suppose this is an unlisted company means, if this is an unlisted company whose net worth is 55 crore. If an unlisted company whose net worth is 55 crore, can they come under phase 1? For they to come under phase 1, it should be 500 crores or more. For them to come under phase 2, they should be 250 crores or more, but less than 500. Correct? No. But here net worth is only 55 crore. That means will Ind AS be applicable for them? Now, if you are in the same example, if you are an unlisted company, means Ind AS is not applicable for such company. They'll have to continue to apply accounting standard itself. That's the answer. Clear, Sarji? Can I move on to the next one, Sarji? Okay, next question. Net worth of a company B, unlisted company. There's an unlisted company, 600 crore. On 31st March 2014. I don't even have to bother reading further. What is it? Whether you are listed or unlisted, on 31st March 2014, if your net worth is more than 500 crore or 500 crores or more rather, you come under which company? Phase 1. Okay. So, all right. On 31st March 2014, net worth is 600 crore. But they are saying next year they suffered loss and their net worth became 400 crore. Now, 31st, first time for phase 1, you check the net worth limit on 31st March 2014. On 31st March 2014, was it 500 crores or more? Yes. Once if you satisfy the limit, it's enough. Next year, if net worth falls, it really doesn't matter. Since on 31st March 2014, you satisfied phase 1 criteria, you'll still be what? You'll still be a phase 1 company only. And Ind AS will be applicable from 1st April 2016. Got it, people? This is the thing. These are also clarification made as a question. Move on to the next now. Look at the next question. This is actually good. No, actually, no. Hang on. Actually, this is good. Net worth of C Limited. It's an unlisted company. On 31st March 2014 is how much? 400 crore. Unlisted company. That 31st March ka net worth is how much? 400 crore. Is it 500 crores or more? No. That means they can't be under phase 1. Okay. Now check. However, net worth was 600 crore on 31st March 2015. Immediately next year, right, their net worth became 600 crore. Okay, 1 second, hang on. This was a clarification given. All right. So, ideally, you are not a phase 1 company. Ideally, if you interpret. Why? Because for phase 1 company, you check the limit on 31st March 2014. On 31st March 2014, did you cross 500 crores or more? No. All right. But immediately next year, you crossed 500 crores and you became how much? 600 crore. No, this was a clarification given by ICA. First time Ind AS is applicable on what day? 1st April 2016. Immediately before that, you satisfied. No, this also will come under phase 1. This also, they've given a clarification that means it will come under phase 1 only. That means what? For your understanding, you can think for phase 1, you will check the limit on 31st March 2014 and you will check the limit on 31st March 2015. Got it? That's a clarification that they have given. Everybody good, right? So yeah, this also will come under phase 1 company from 1st April 2016 onwards. Okay, Naji. All one liner answer here. We are under which phase? You need to follow Ind AS from which day, which day. That's all is answer. Don't worry about all the story. Just focus on the things this have written. That's more than enough for exams. All these are 1 marker, 2 marker question. Beyond the doubtful. Online also, can I move on, people? No issues, right? Okay, 5th question. Company A is a parent company of a group. Okay, now I think they're talking about family affair wala application. Probably this question is around that. Company A is a parent company of a group. Okay. Company A is an unlisted company. Their net worth is 60 crore on 31st March 2014. That means parent company. Did they satisfy phase 1 ka limit? No. Phase 1 ka limit is 500 crores or more. Here it is only 60. So failed. Okay. Following are other companies in the group. A is the ultimate parent. This A has a subsidiary called company B. They also have another. Okay. Name of the company is B. Relationship, it's a subsidiary of A. Then we have another unlisted company called C. They are subsidiary of B. That means the structure is what? A has a subsidiary called B. B has a subsidiary called C. It doesn't matter. Still, this is a group company only. Okay, na Sarji? Fine. No. These are all group companies holding subsidiary company in this structure. Now, what is this B ka, one subsidiary ka net worth as on 31st March 14? 600 crore. So it is 500 crores or more. That means it comes under company B comes under what? Phase 1. All right. Now, one subsidiary company C ka net worth is 150 crores or more. That means what? Here A, B, C. I think I've written. Here I've written. Why should I write again? A has a subsidiary B. B has a subsidiary C. A ka net worth on all these data is on 31st March 2014. 14. A का net worth is 60 crore, B का is 600 crore, C का is 150 crore. So that means ideally A and C have failed phase 1 ka limits because the net worth is not 500 crore. But doesn't matter. If B satisfied, no? B satisfied, B ka net worth is 500 crores or more as on 31st March 2014. So B has to apply what? Ind AS. And we know if a company is applying Ind AS, their parent, their subsidiary also have to follow Ind AS. Whether the net worth limit is satisfied or not satisfied really doesn't matter. So that means what here? All the companies will come under phase 1 and they have to apply Ind AS from 1st April 2016 onwards. Got it. This is a family affair. So one company is satisfied the net worth means their parent, their subsidiary, joint venture, associate ka net worth, you don't have to check whether net worth is satisfied, not satisfied, still they have to apply compulsorily Ind AS. That's what this question about this. Sir, all of this, anything and everything here can be tested. So I don't want to keep anything as LDR. If you want all this quickly, you can review on the last day. Better maybe. Okay, question number 6. Okay, look at this structure now. You need some time to process or write anything? No? Okay. Company, 6th question. D has 2 subsidiary called E and H. It's a typo. Company D has 2 subsidiary called E and H. E has 1 subsidiary F and 1 associate G. H has 1 subsidiary I. Okay, so structure is like this. D has 2 subsidiary E and H. E has 1 subsidiary called F. E has 1 associate called G. And H another subsidiary, they have another subsidiary called I. This is a structure that they have told. Okay, now what are they saying? Check. All the companies in the above structure are unlisted. Okay, great. Their net worth of company E ka net worth is 300 crores or 300 crores. And net worth of all other companies is below 250 crores. Only one company E ka net worth is what? 300 crore. Rest all the companies ka net worth is below 250 crore and they are all unlisted also. That means ideally all other companies should apply AS because their net worth, they are not listed. Their net worth is below 250 crore. So ideally you need to apply AS. But hang on. Ind AS is a family affair. E ka net worth is how much? 300 crore. That means E will come under which category ideally? Phase 2. They can't come under phase 1. They'll come under phase 2. Right? Phase 2 means Ind AS applicable date is 1st April 2017. Ideally. First time if you are under phase 2, you'll apply Ind AS from 1st April 2017. Agreed? Now, if that means E has to apply Ind AS. If A has to apply Ind AS means their parent D, their subsidiary F, their associate G also have to apply Ind AS. Comfortable? That's a provision. If you are applying Ind AS, your parent, your subsidiary, your associate, your joint venture also has to compulsorily apply Ind AS. That means all this compulsorily have to apply Ind AS. Agreed? That there is no doubt. What about H and I? Ind AS is not applicable for fellow subsidiaries. These two are known as fellow subsidiaries. D is a parent having 2 subsidiaries. No, co-subsidiaries or fellow subsidiaries. Ind AS is not applicable. That means H and I, Ind AS is not compulsorily applicable. H and I, if they want, they can continue with what? Accounting standard. Okay, now so Ind AS is only applicable for your parent, your subsidiary, your associate, your joint venture. But for co-associates, co-subsidiary, fellow associates, fellow subsidiary and all, Ind AS is not compulsorily not applicable. That means here what, sir? These companies D, E, F, G have to compulsorily apply Ind AS. Okay, D, E, F, G. But what about H and I? H and I, is it compulsorily applicable? No. But voluntarily can H and I adopt Ind AS? Voluntarily any company can apply Ind AS. Compulsorily H and I is not Ind AS applicable, not applicable, but voluntarily if they want to adopt, they can adopt, which obviously they will do. Correct? Now what do you think parent will tell you? Right, for consolidation, all this is doing Ind AS, here if you to follow AS, then it will become double work. No? So parent will tell H and I, you also apply Ind AS in that case, just to ease in. But anyway, that is their choice. This is the takeaway from this particular question. So Ind AS is not applicable for fellow subsidiaries is the concept of this particular question. I've sent this file, you can refer it. Only that amendment ka 1 page is not included, that's all. Rest all file is same, there is no changes, right? I just added that today morning, that's all. With that also I'll send. But otherwise you can refer all these questions, it is fine. Done. Sixth question is also done. Can we go for the next one? Online, can you quickly confirm?
It's the parent rate.
What, sir?
D.
D is the parent, sir. Correct, sir.
D is subsidiary, then.
Huh?
So subsidiary, their subsidiary.
So, tell me in structure. Here, E's parent is D.
No, D I'm saying.
Mm-hmm.
So their subsidiary has to follow in days. D is following in days. So their subsidiary.
He's saying, sir, if E follows Ind AS, D also has to follow Ind AS. If parent is following Ind AS, their subsidiary also has to follow Ind AS. Cross connection is establishing. Correct only, but what it is how is D applying Ind AS? As a direct limit or indirect route? If you're going through indirect route, then your subsidiary, that logic you'll have to cut. That connection you'll have to cut. Understood? Huh? Everybody? Fine. So that's what if D on through their net worth, through their net worth, if they have to apply Ind AS, then their subsidiary also directly. But through indirect route, if parent is applying Ind AS, then they're saying the fellow subsidiaries need not apply. That's what they have given there. But practically, people, all this issue will not arise at all. If parent is adopting Ind AS, then absolutely you can be sure that everyone in the group will apply Ind AS. This will not arise at all because parent will tell, even if it is not satisfied, voluntarily adopt. No company would like to have one group company following AS, another group company following Ind AS. That will just create some confusion for people working around. First of all, accounting and all, they don't like. Businessmen, more they're thinking more line on the top line, bottom line, share price. Their mind will go in that direction. This and all, they would not like to comply. That is the reason I say that we need to change our mindset. Right? Currently, yes, the reason why CAs are getting underpaid compared to the MBS is because of this. We are all choosing the compliance role, right? So we are all going behind audit to get it and all. But company, people, they don't want to pay the auditors. Why? You only think. What are we doing? Going to the company, pointing out company ka mistake and telling correct it and charging money for it. What is the value add? Where is the top line getting increased? Yes, reporting is important, showing things are correctly. But businessmen will always think about profits, increase in the market share, increase in revenue and all that. That, most of the chartered accountant roles, whoever most of us are getting into, we are not getting into those roles. Most of our roles are compliance, right? Some compliance or the other, either audit compliance, internal audit or tax compliance or whatever. And people don't like compliance. Including you and I also don't like compliance, correct? You like to follow rule. Given a choice, if there is no signal, early morning, 4 o'clock, if you are driving, if there is red light, it means you will wait. Yes or no? Right? Nobody would like to follow the rules, right? Rules has to be imposed. So company is thinking all of this as an imposition, right? So that's the reason if we change our mindset, see, we have amazing finance domain knowledge. I have nothing against top tier MBAs. Please don't look at it that way. I really respect the efforts. It is not easy to crack an IIM ka seat with lakhs and lakhs of people achieving. So there is a hell of a lot of efforts, right? So they would have done crazy, insane amount of efforts to get there. I deeply respect them for that. It's a great discipline, an amazing, inspirational, definitely inspiring thing, right? We can look up to them for that. But my thing is, when we are an authority in finance, anything and everything relating to finance, right? People come to us, right? So when we call ourselves authority in finance, then why should we not go into those kind of knowledge where we can contribute more to role, right? Heading of finance, not just heading the finance function, more towards strategy wala roles, which usually goes off to the top tier MBAs. That's the reason their starting package is 25-30 lakhs plus, where our starting package is still there is still a difference between that. Because see, we have learned so much through our books. Quantum of syllabus is so much. We have 2 years of articleship experience. They have college experience. We have actual work experience. Ideally, we should be more than them, right? Or at least at par. But we should not be almost half of what they're getting. That's not what we should be drawing, right? Problem is that one is with respect to confidence. Most of us are not that good in communication. Communication does not mean that you'll have to be expert in English. No, right? We need to have that confidence to put across our thoughts and stand for what we believe in. Most of us just will accept it. That's what has happened from you could say most of our generation previously or with us also. We just accepted what we came. We're not naming high. We're okay, we got 10 lakh package. We'll be hey, yeah, party, yeah. But we are not thinking more towards how do I crack into that 1 crore package within 4 to 5 years, which usually MBAs go, right? How do I get into those sort of roles, right? So we need to think on those lines. We can't be makki ka makki. right? I will just prepare, I will study, and I will vomit that in exam and I'll clear. If you're doing that, you will get the same roles. MBAs are getting paid more because they analyze. They're not dependent on. See, MBA as a course, right? Teachers will not teach everything. It's all research based. They'll teach. Teachers will teach 20%. Figure a balance 80%. You have to research. You have to collaborate. You need to network. You need to learn. So those are the skills they want you to develop. But at CA, what is happening is when comma full stop also we are teaching. Irony is that also. One RTP new question comes means we'll get so many doubts. So RTP, one new question has come. Please make video soon. Sir, you are about to become chartered accountant, right? One question, one small concept if you're not able to handle. And moreover, you know this, right? CA is a PhD course. PhD is a research-driven course. So, but what our mindset has become is from our foundation days, all our teachers, even we are also to blame, right? We also have thought every comma, every full stop, every question, every RTP, every MTP, moment it comes, everyone will be like, hey guys, how YouTube video. Right? Every faculty is doing that. Of course, it's sort of marketing. We have to do it. So we'll do it. Nothing against that. But what is happening is that is turning our profession, our people into more like, they're making us too dependent. Now, when your mindset is like this, suddenly when you qualify and go into a company, now you can't tell your company, give me this, give me that. They will say, why am I paying you for? Research. And suddenly it will hit you. Right? What do I do? What do I do? Right? That is where an MBA will take that as a challenge. In fact, they'll crave for it. They'll pitch for that. You give me it, I'll take care of it. I know how to get it done. I may not know, but I will talk to people. I will get it done. That is a skill we are lacking. So we should upgrade ourselves in that. Start depending on ourselves more. Start researching. Right? And so these sort of things. And start reading the research papers. If possible, publish it. Whenever there is an opportunity, when a student conference happens. You're right. Address. It's okay. Make a fool out of yourself. No problem. But it's good to stand there and address 1,000, 10,000 people. It'll increase the confidence. So those confidence, all those are soft skills and things like this also we need to concentrate on. Just don't focus only on getting marks. Yes, if you are a rank holder, you will get the first decent package. But if you're not good enough, if your communication skill, networking skill, upgradation skill is not good enough, in 1 or 2 years, they will not promote you. Probably they might fire you. You've seen that happen. Some of the rank holders of CA getting fired after getting 20-25 lakh package. Because makki ka makki. Ditto, mug up for 6 months, 1 year and done. But actual application of work not happening. And no companies would like to spoon feed you. So we need to focus on those lines, right? So amazing roles are there. So we'll also try. That's what I would say, right? So as much as possible, be vocal, be participative. That's what I would suggest. Take every platform as an opportunity. It is okay. Few things you'll embarrass yourself, right? You'll make a fool out of yourself. You'll have that stage fear, right? You'll say 101 nonsense things, but it is okay. That's how you'll learn. That's part of life. Straight away you did not walk, no? First you are walking on that 4 legs only, no? Laka. Now if somebody walks, a grown man or woman walks like that, we'll be like, hey, right? But as babies, that's how we learned walking, right? If we had not taken those baby steps, we would never be walking on our 2 legs now. A baby will never think, oh, I'm making fool out of myself, right? It just does. So it's time for us to be a baby in terms of thinking, not in terms of mentality, yeah, right? But yes, so let's inspire each other, build that network, right? And take this profession to a lot higher level that actually it deserves, in my view. Okay, sir. Question number 6. I point da. Finished da. 6 we did da. Oh yeah, this one. Oh, did. Question number 7. Come to 7. Question number 7. Jai Balaya, na? Okay, Jai Balaya. Okay, ABC Incorporated in a foreign country. ABC Incorporated in a foreign country. Underline, Madi. So it's not an Indian based company. It's a foreign company whose net worth is 700 crores. Stop there only. Ind AS is only applicable for Indian registered company. Ind AS is only applicable for Indian registered company. This is what? Foreign registered company. Foreign registered company ka net worth may be positive, negative, 1,000 crore, 1 crore, it doesn't really matter. Ind AS is not applicable for them. Ind AS only applicable for Indian registered company. Point number 1. It has 2 subsidiaries, XO, whose net worth as on 31st March 2014 is 600 crores. Okay. Y, whose net worth is 150 crores. Okay. Whether X and Y would require to follow Ind AS. They're not asking ABC. ABC, since it's a foreign company will not apply Ind AS. So I'll just give you a structure here. ABC is a foreign company. So Ind AS is not applicable to them. Got it? This foreign company has two subsidiary called X and Y. What is X ka net worth? X ka net worth on 31st March 2014 is 600 crore. Is it 500 crores or more as on 31st March 2014? Yes. That means X is which company? A phase 1 company for which Ind AS is applicable from 1st April 2016. So X has to comply. X is an Indian company. Yeah? X and Y are Indian registered company. Only ABC, parent, is a foreign company. A foreign company has two Indian subsidiaries. Since Indian subsidiary X ka net worth limit as on 31st March 2014 is 500 crores or more, they come under phase 1 and 1st April 2016 they need to apply. Ideally, if you are applying Ind AS, your parent also has to apply Ind AS. But for your parent to apply Ind AS, it should be an Indian registered company. Is your parent an Indian registered company? No. So ABC will not apply Ind AS. Even this family root will not be applicable to them because it's a foreign company. And Ind AS is applicable to fellow subsidiary. X, Y is a fellow subsidiary or co-subsidiary. Will it be applicable? No. Because, and why did they satisfy the limit? What is Y ka net worth? Y ka net worth is only 150 crore. No. Why? That means Y has not satisfied the limit. So for Y, Ind AS is not applicable. They'll continue with AS. Voluntarily, if Y wants to adopt Ind AS, they can do so. That's fine. That's their choice. That's about question number 7. This is the answer. ABC, Ind AS not applicable. Company X, Ind AS not applicable. AS applicable. Company X, Ind AS is applicable from this state. This graph only is your answer. They've written all that. Okay. Now this is for what? So far we read the limit. That is applicable for what? So far, whatever we saw the limit, it's applicable for companies which is not a bank, which is not an insurance company, which is not an NBFC. What if you are an NBFC, non-banking financial companies? Even NBFC ka main business is same only, no? Right? Give out basically loans. Some NBFCs also accept deposits, right? But NBFC, you can't open a savings account and all in NBFC. They can't do that. But otherwise, yeah, accepting deposit and giving out loan is the main business of NBFC. So similarly, they fall similar to, in terms of operation, they are similar to a banking company. Okay. So if you are an NBFC, then again, for this, right, for banking, they'll not have, see, banks know when they give out loan, it's a financial asset. Normal company will have maybe 1 or 2 loans. So it's easy to do effective interest rate to fair value and all this. But banks and all, no, they will have hundreds and thousands and lakhs of loans. So banks told we are not ready. NBFC told we are not ready from 1st April 2016 because we still need to prepare. So many are there, it's not possible. So hence for NBFC, they pushed it by 2 years. Same limit, same thing, but just how many years? So their normal company, what was phase 1 ka date? 1st April 2016. Here it will be 1st April 2018. Phase 2 ka NBFC will come under 1st April 2019. Same limit, same thing. Just 2 years pushed. Everything 2 years pushed. Easy to remember. Okay, tell me now, if you know, tell me which NBFC will come under phase 1. Those NBFCs which are already listed or in the process of listing their shares or securities in India, whose net worth is 500 crores or more. Even unlisted company, if your net worth is 500 crores or more, then you come under phase 1. If you don't satisfy phase 1 category, then you come under phase 2. All listed NBFC or in the process of listing NBFC, whether shares or securities in India or abroad, if they don't get covered under phase 1, they come under phase 2. Unlisted NBFC whose net worth is 250 crores or more but less than 500 will come under phase 2. And if you are following Ind AS, then same, your parent, your subsidiary, your associate, your joint venture also have to apply Ind AS. Ditto limit to just the date, 2 years pushed. Okay. So which day you will check the net worth, sir? Same. There you check the net worth first time on what date for normal company? 31st March 2014. 2 years later here. It will be what? 31st March 2016. Here you will check the net worth limit on 31st March 2016. Everything 2 years. That's a very simple thing. Easy way to remember. Comfortable, Asarji? This is what we did in that particular question of Ind AS 101. Now, if you just check, if you are a normal company and if you are a phase 1, then you will start applying Ind AS from 1st April 2016. But if you have a parent or if you have a subsidiary, which is a NBFC, then they will apply Ind AS only from 2018 or 19. So that time, Parent can become first time adopter earlier than subsidiary, or subsidiary can become first time adopter earlier than parent. That's what Ind AS 101 may we learned as provision. Understood? Huh? That's where is the thing. So only if one is a normal company and one is an NBFC, then Ind AS application date for both can be different. But otherwise, you will all apply under the same date. Easier. Sir, NBFC will apply Ind AS from what maximum? From the earliest date they'll apply Ind AS is only 2018, not before that. NBFC first time will apply Ind AS only from 1st April 2018 onwards only, never before that. Okay, that's the first time it will be made applicable to them. Okay, and for NBFC they are saying voluntary adoption of Ind AS is not permitted. For other companies it's okay. For NBFC they said, maybe I don't know what is the thought process behind this, but they have not allowed the voluntary adoption of Ind AS for only NBFC. This is about NBFC ka limit. Ditto. Just 2 years, everything you push. That's all. Easy way to remember. Can I move on to the next? You will check the net worth limit again on what? For normally, normal company, you check net worth on 31st March 2014. Here you check the net worth on 2 years later, 31st March 2016. If it is satisfied, you come under phase 1 like this. Okay. Sir, what if you fail net worth? What if your net worth is 50 crores only? Okay. Or what if your company is not registered? Sir, it's just that, see, every year you have to check the net worth. Every year you have to check the net worth. Once limit is satisfied, once a net worth limit is satisfied, you have to start applying Ind AS. After that, you don't have to check the net worth. Right? Till, see, if Ind AS is not, if you're following accounting standard means, every year you'll go on checking the net worth and see if Ind AS is applicable to you or not. Once Ind AS is applicable, from next year onwards, you don't even have to bother the net worth. That's the thing. Okay. Everybody good? Suppose till 31st March 2019, net worth limit failed. But net worth as on 31st March 2019, first time crossed 250 crores. Or it became a listed NBFC. Then immediately next day means from 1st April 2019, that is 1920 year onwards, you'll start applying Ind AS like this. Okay, na sir. So if net worth limit satisfied on 31st March 2025 for the first time, then what, sir? From 1st April 2025 onwards, you will start applying Ind AS. Meaning from 25-26 year onwards, you need to apply Ind AS along with comparative statement of 24-25. 1st April 24 being the date of transition. That's the thing. Done now. Now relating to NBFC, there are I think few questions. Can we take that up? Okay, come to question number 8. As a roadmap, Ind AS is applicable to company X. Read the data carefully. Company X Ind AS is applicable from what day? 17-18. Because they satisfied maybe net worth limit, so they need to apply Ind AS. Okay. Company X is a non-finance company, so it is a normal company. We'll call it as normal. It is a subsidiary. Company X is a subsidiary of company Y. But Y is what? NBFC. So parent is an NBFC, subsidiary is a normal company. And subsidiary Ind AS is applicable from what day? 17-18. That means, can you say from 1st April 2017 onwards? This is the problem. Why? NBFC, first time will apply Ind AS only from 1st April 2018. Right? But subsidiary already is applying Ind AS from 2017 itself. Okay, what are they asking? Company Y is an unlisted NBFC. Company Y is an unlisted NBFC whose net worth is 400 crores. Okay. What will be the date of applicability of Ind AS for company X and Y? Okay. We'll read the second part later. So, date of applicability, tell me, sir. What is it? What is it? X, they already told. What is that? X, they only told Ind AS is applicable from 2017-18. That they only told. Correct. What about Y? Y is an unlisted NBFC and their net worth is what? 400 crore. Fine. First time in NBFC can apply Ind AS only from 1st April 2018 onwards, provided their net worth is 500 crores or more. Is it 500 crores or more? No, it's 400 crores. Then they come under what? Phase 1 or phase 2? Phase 2. Phase 2 application date is 1st April 2019. So this Y, that is a parent ka NBFC, they will apply Ind AS only first time. First time they will start applying Ind AS only from 1st April 2019. Okay, na? That means which year? 2019-20. For this 2019-20, they will start applying Ind AS. Okay. That means what? Now this part is okay. There was one more question. Is this okay? Now the second part of the question is, if Ind AS is applicable, if Ind AS applicable date for parent is different from applicability date of subsidiary, how the CFS will be prepared is what they're asking. Now you tell, sir. For 17-18, you will prepare a consolidation as per what? Sir, in consolidation, CFS is always, consolidated financial statement is always prepared from the parent perspective. For 17-18, parent was following what? Ind AS or AS? So 17-18 CFS will be prepared in AS. What about 18-19? 18-19. Sir, parent is applying Ind AS only from 19-20. That means 18-19 also, 18-19 also, you will prepare CFS as per AS. This is CFS. This is what they've asked. Oh, what about separate financial statement? 17-18 onwards, X Limited has to apply Ind AS. So that means separate financial statement. X Limited ka SFS. This is SFS. S Limited ka separate financial statement will be as per Ind AS from 17-18, 18-19 onwards, because from this year only this has to follow Ind AS. No? Okay. What about separate financial statement of parent? 17-18, 18-19. Ind AS is only applicable from 19-20, but before that it is which standard? AS. This is SFS. Any problem or sorted? This is what they asked. Actually, this they did not ask. They asked this. How will you prepare CFS? For 17-18, 18-19, you will prepare AS. Sir, how do you prepare it, sir? Sir, Y Limited ka SFS is already there in which platform? AS ka platform. But X subsidiary ka financial statement is on what platform? Ind AS ka. So straight away, can you add AS ka, Ind AS ka financial statement and prepare CFS? No. I mean, subsidiary ka financial statement from Ind AS, you will have to reconvert it into AS. For what purpose? CFS purpose. For CFS purpose, subsidiary will prepare one more financial statement as per AS and give it to the parent. Parent will use that AS ka financial statement and prepare consolidated financial statement. Like this. Same drama happens in the next year also. From 19-20 onwards, if your mind is running in that direction. 19-20 onwards, what? X is already applying Ind AS. Subsidiary. Parent also will apply Ind AS. And consolidation financial statement also will happen through Ind AS. This is your 19-20 drama. Clear? Alright, let's move on to the next question then. Sir, what about banking and insurance companies, sir? As of now, the way I've checked, right, Ind AS is not applicable for banks and insurance companies. They say they're still not ready. Maybe your juniors will get caught. Okay, for you, you are escaped too. For banking and insurance company, as of now, what I've checked, Ind AS is still not made applicable. So you don't have to worry about that. Sir, what if bank has a parent company or subsidiary company, sir? Okay, look at the structure. X Limited. Okay, I think you're right. Finish. Now let's say X Limited, normal company. They are following Ind AS. They are following Ind AS because their net worth limit satisfied. But X Limited is controlling, let's say, State Bank of India. Not the reason, but just take the example. X Limited has a subsidiary called a bank. Banks can't apply Ind AS. They are following what? Accounting standard with RBI regulations, of course. Okay. Now the question is, parent is following what? Ind AS. But subsidiary, which is a bank, has to follow AS. How will you prepare CFS? What we'll have to do is, sir, for reporting purpose, for separate financial statement reporting purpose, banks will present their financial statement as per AS. But they'll prepare one more financial statement as per Ind AS and give it to their parent for what purpose? CFS purpose. Only for CFS purpose, banks will prepare one more financial statement and give it to the parent. Using that Ind AS financial statement, parent will use and prepare CFS. Like this. For reporting purpose, banks cannot use Ind AS. For SFS purpose, they cannot use Ind AS. First, SFS of a bank will always be presented on what platform? AS ka platform. But for CFS purpose, if they have to give any Ind AS ka financial statement, they can make it available. That's fine. This is that concept. This is what is given in point number 1 and 2 there. It's given, I've just made it as a chart here. Clear, sir? Okay. So now there are some other pointers also, or let's do a thing. Maybe some of our YouTube audience are looking for amendments. Okay, so I make them wait. I'll do of the amendment first and then take up the remaining concept of this particular topic so that they can also move forward with their preparations. Fine now. Anyway, that is a separate concept, so it doesn't interrupt the flow of the chapter any which way. So I'll just quickly go through that amendment with you. It's there in the note. Maybe in your file it is not there. I just added this now. Okay. But recorded guys, don't have to worry. This amendment file also we have already uploaded. It's there in the paid version of the course. Don't tell it's not there. There at least it is there. Now this is the concept. There are a lot of amendments, okay, but all of them are falto amendments. Just theory thing. Nothing much practical relevance, right? There's a separate video. If you want, you can watch that. Okay, fine. And this is okay. On the YouTube, it's already there. But most of them are falto amendments. Only one amendment, which was an important concept actually. Right, that concept has become very falto now. So amendment has not increased your workload, it has decreased here first time. ICA has actually given you not extra work, they have reduced your work. Okay, before that I'll just give you a background. Maybe some of you already have prepared and you have just come for the amendment, so you might know that. So I'll tell you what was the old provision, then I'll tell you what is that amendment and what we need to follow, right? So I'll just discuss the old provision first. Don't apply this. This is just old, just to get for our previous audience, just to establish the context, I'm telling the previous provision. Previously, what is this provision is? Sir, you have taken a long-term loan. You have taken a long-term loan and you have committed some breach. You have done some violation. You have taken a loan, long-term loan, either from debenture holders or from a bank, whoever, doesn't matter. You have taken a long-term loan. Normally, when you take a loan, loans and all will come with some terms and conditions, right? That terms and conditions, if you violate, like here, let's say, okay, the concept is breach of long-term loan ka covenants. Covenants actually means restrictions. You can also analyze it as a terms and condition. Okay, look at this. What is this? Suppose on 1st April 2025, sir, this is old provision. This is only applicable till 31st March 2026. So your attempt is obviously beyond that. Now you already passed this data. So that means you can't follow this. From 1st April 2026 onwards, you have to follow new provision. I've written the date also. So we will follow this. But before, what was the provision? I'll give you a context. Let's say on 1st April 2025, a company has taken a loan of 15 crore. For how many years? 7 years. So it is obviously a long-term loan. One other condition for this loan is debt equity ratio should be maintained at 2:1. It should not exceed 2. Meaning for 1 rupee equity, maximum debt you can borrow is 2. That was one of the conditions. If debt equity ratio exceeds 2, right, then debenture holders or bank people can take back their money. That was one of the conditions. When a person, let's say we have taken a bank loan, right? Bank gave us a loan of 15 crore and put one condition saying debt equity ratio should not exceed 2. It should not cross 2. If it exceeds 2, if the actual debt equity ratio exceeds 2, then bank has a right to take the entire loan back. 15 crore becomes repayable on demand. If these terms and conditions are violated, the loan becomes repayable on demand. Under these conditions, we took a loan. Clear? Now let's say on 31st March 2026, okay, just for your context, I'll give you this. Suppose debt has become 100 crore. Debt has become 100 crore, total debt, right? Equity refers to equity and other equity put together. Okay, let us say is 25 crore. Equity is 25 crore. Calculate debt equity ratio for me. How do you calculate debt equity ratio? Debt divided by equity. Total debt is 100 crore. Total equity is 25 crore. Means this is 4. Agreed? That means what? Debt equity ratio is 4:1. For 1 rupee debt, or rather for 1 rupee equity, we have a debt of 4 rupees. But what is the condition? Debt equity ratio should be maximum 2. If it crosses 2, loan will become repayable on demand. Now here, did it cross? Did we exceed 2:1? Yes. That means on 31st March 2026, the loan has become what? Breach has happened. Whenever you violate the condition, what will happen to the loan? It will become repayable on demand. Sir, something which is repayable on demand, can it be a non-current liability? Sir, initially when you took the loan was for 7 years. So you would have classified this loan as what? Non-current liability. That loan will be shown in your balance sheet as non-current liability. Now, since at the end of the year you violated a condition, the loan has become repayable on demand. Something which is repayable on demand is not non-current liability. It is a current liability. Understood? So on 31st March 2026, the loan has become current liability. Any problem till here? Initial classification of this loan was what? Initially, this loan will be classified as a non-current liability when you took the loan. But on 31st March 2026, since you committed the breach and loan has become repayable on demand, from NCL it will become CL. As in now from non-current liability it will become current liability. Good, okay. And now what do you think? Let's say government bank sent a notice. Macha Kudra, Tirpi Kudra, 15 Koti. Notice one. 15 crores, we got a notice to, bank sent a notice, give my money back because you have violated the condition. Now what you will do? Bank managing directors and all will go, yo, you know what happened? Oh, like that will go and try to Muscafy, you know, put Musca butter to manage, no? Let us say on 25th June, company ka directors met the bank and told, ayo, daivame, prabhuve, ignore no. Adjust ಮಾಡ್ಕೊಳ್ಳಿ, adjustment is India's second name, no? Yeah, right. No? So on 25th June 2026, directors approached the bank and told, kindly adjust, give me some more time. Don't ask, don't be so like this. We have done relationship from so many years, right? I see you more than my wife and husband. Yeah. So why are you doing this to me? Like this full butter you put. Lender, banker, agrees not to demand repayment. Banker told, no problem. I will ignore your breach. They did not ask us to correct. They told, I will ignore your breach. So lender agrees not to demand the repayment by ignoring the breach. Either that case could have happened, or lender told, I will give you grace period. I will give you extra time, a grace period to correct this breach. To correct this breach, I will give you extra time. That we call it as grace period. Okay. So previously what was the provision was, if the lender, if the bank, if they choose to ignore the breach and not demand repayment, or if grace period is given, extra time is given to rectify the breach for a period of, how much grace period should be given? 12 months or more, right? This used to be treated as an adjusting event. This used to be treated as a adjusting event. Let's say, when did all this drama happen? 25th June. But let's say current year ka financial statement got approved by the board of directors on 10th July. Now we know, as per Ind AS 10, is it an event? For it to be an event, it has to occur between this window, balance sheet date and financial statement ka approval date. That particular, all this grace period drama and all, is it occurring before 30th July? Yes. I mean, this is an event. And this one, no, they used to say, treat it as an adjusting event. Treat it as a adjusting event. Now, lender is asking the repayment or not asking. So that means what you have to do. Initially, the loan ka classification was non-current liability. Then you classified from non-current liability to current liability. Now, it is treated as an adjusting event, means again you change the classification from non-current liability to, or from current liability to non-current liability. That was the previous provision. That means ultimately what is the answer? On 31st March 2026, balance sheet when you prepared, you used to still show this loan as what? Non-current liability only if this has happened. Because the treatment was, you used to treat this as a adjusting event. Fine. Now they use substance over legal form. In reality, is bank asking the money bank or they did not ask? Hence they told, continue with your original classification of non-current liability. Comfortable. So the order is here. First from NCL it will move, on the breach date it will become CL. If that breach is rectified, or if grace period of 12 months more was given before approval of financial statement, again you will change the classification to non-current liability, and current year ka balance sheet mein used to show that loan under NCL. This was the old provision. Here I had given a big chart. The chart is there in this notes also, right? Sometimes this used to happen, sometimes grace period used to be given. So I had made a big chart. Now all this has become faltu. Actually, this was a carve out. This was a carve out. Carve out means what? Difference between IFRS and Ind AS. Ind AS said what is the classification? Ultimately, what is the classification of this loan here? Non-current liability. IFRS, you know what they said? I don't worry about all this. All this has happened in the current year or next year? Next year. On 31st March, did you commit the breach? On 31st March, did you violate the condition? Yes. Because of violation, what is the nature of this loan? Repayable on demand, you show it as current liability. I don't care what happens after this. As on 31st March, has a breach happened? Yes. Has the loan become repayable on demand? Yes. Then show in this year balance sheet as a current liability. That's all IFRS said. After this, so you approach bank, you get it done. That is another event. If later on, if banker says, I don't want the repayment, means you change the classification. But you will change the classification from current to non-current liability on what date? 25th June. That's what IFRS told. On 31st March, show this loan as current liability because it is repayable on demand. Later on, if extra events happens, you can change the classification again from CL to NCL. This was what IFRS said. So IFRS did not have all this drama. Ind AS we brought in all this drama. Now the drama IAS told we will remove and we will follow IFRS. This is the new provision. Understood? I mean, as per the new provision, tell me what is the answer. Should I have to worry about Gresu, Gisu and all this? No, I just need to check on my balance sheet date what is the position. On balance sheet date, what is the position? Is breach condition violated? Yes. If condition violates, what will happen? Loan becomes repayable on demand. Any loan which is repayable on demand is what liability? Correct. I mean, as per the new provision, I mean, this is not an adjusting event now. If you want to call it, this will be treated as a non-adjusting event. That means the classification will be what? Current liability. Finally, this is the answer. This is what you will follow here. This is what IFRS says. Now, Ind AS is also saying the same thing through an amendment. So, the old provision has got substituted with the new one as an amendment. And this is applicable from 1st April 2026. Got the final answer? So, finally, what? On 31st March 20, what you will do at the end of the year? What you will do? Show this loan in the current year balance sheet. You will show this loan as a current liability only. That's meaning you will not treat it as an adjusting. You will treat it as a non-adjusting event. So, classification of the loan will remain the same. Current liability only. So, easy protection. Okay, na, sir? That's all with respect to this amendment. Paka, everybody got it? Any questions online has in this? This will come up. We have a couple of questions on this. We'll take that up. That's fine.
Disclosure actually given.
Yes, you can disclose. You see, extra voluntarily, if you want to disclose anything, you can. But there's not any standard. No. Standard talks about disclosure requirement. This came as an amendment, really. So, but voluntarily, you can. It's fine. Done. For all other amendment, you can check your YouTube video. Okay, but all others are just provision, nothing numerical. Theory amendments, right? Faltu. Most of them are faltu. One quick read you give it. It's there on the YouTube. You can watch that video if you want other things and all here for this. Yes, so that is done. So now I think we can get back to our normal thing now. Okay, now come back to our normal fitting. Now the YouTube audience, you can leave. Right, you got the answer, no? Amendment, this all is amendment. Now we are continuing with Ind AS 1. If you want to stick around, happy to. Otherwise, tata bye-bye, best wishes. Yeah. Which question, where we were in? This we have done. Okay, till here we are done. Okay, let's move forward to the next phase. Start, Sarji. Okay. Now, frequency of reporting. Sir, how often should you report? In India, you need to report at least once in a year, annually. Once in a year, you need to report your financial statement. You need to present your financial statements once in a year. And you need to present with what data? 12 months data. Right? You use the 12 months data whole year. From April to 31st March, whatever transaction has happened, you need to capture in your financial statement. So, how many months ka data you are capturing in your financial statements? 12 months. But suppose first year you registered only on 1st June. Year starts on 1st April, but first time a company was registered only on 1st June. Current year is this, but the registration is there. That means in the first year they'll prepare financial statement what? 10 months, because they got registered only in June. April, May company was not in existence, means first year they'll prepare financial statement only for the 10 months or maybe less than 10 months. This is okay. This is acceptable. Fine. This also will be, this is not IFR. This will still be considered as annual financial statement itself. Okay. How about next year when you prepare? This is 1920. Next year, will you capture 10 months data or 12 months data? 12 months data and prepare financial statement. Right up. Now, next year when you prepare financial statement, you not only have to prepare that year ka financial statement, but previous year ka financial statement, you need to give it for comparison purpose. And here you need to give a disclosure. What is that? These two are not fully comparable. This is for how many months data? 12 months data. But this data is only for 10 months. So you will disclose that this is a position. So they are not entirely comparable. Such a disclosure you need to give. That's what is written here. Got it? What is summarized over here as point. Basically, using 12 months data, at least once you need to report. But there could be some cases where you may be preparing financial statements for less than 12 months, especially in the first year or last year. So you will justify that. Why are you preparing for less than 12 months? You will give a justification saying we got incorporated only for 10 months or company shut down within 7 months. Hence, last year we prepared financial statement only for 7 months. Okay. But next year when you present financial statement, next year ka data will be for 12 months. Previous year ka data in this example is only for 10 months. So you need to give a disclosure saying these two financial statements are not totally comparable because this is 12 months data, previous year is 10 months data. Such a disclosure you need to present. That's what is given here. Done, Asarji? Okay. Next one. Next is rounding off. In rounding off also there was an amendment, but this was very old amendment, 3 years before or something it came. So that's okay. This is a revised one. It's okay. Sir, earlier round off, I think is if my memory was right, it was based on revenue. Using the revenue, we used to prepare round off. Round off means, sir, values will be huge, no? Right? You may have 10 crore, 85 lakh, 42,146. Some number could be like this. Alright. Now, if you present like this, sir, this is okay, 10 crore. Reliance and all, they will have what? 10,000 crores and all. Now, if you present them as full numbers, nobody will understand. Because after five digits, our mathematics will go little weak. Right now, we check for comma, where the comma has been put. Trying to analyze crores or lakhs or what it is. So big companies, their data will go in thousands and thousands of crores. So if you present full data in your financial statement, full number if you present, many of them may not understand. That is where the concept of rounding off has come. Right? So you will not give full number, you will round off. Meaning you will present the data either in hundreds, thousands, lakhs, millions, crores. Like this. So if it is 100 crore, 82 lakh, 14,244, then you can just simply say 100.82 crores. This is round off done in crores. Like this. Right? So next provision is, sir, in what provision should we do the round off? Should we do it in hundreds or thousands? Or should we do it in lakhs or millions or crores or what? That is what this provision is. Okay. And that round off provision as per Ind AS 1 no, is based on the total income. Is based on what? Total income. You will check your total income. If the total income is below 100 crore, if it is below 100 crore, if the total income is less than 100 crore, a company is free to round off in hundreds, thousands, lakhs, millions, maximum millions. Four platform. They can choose one of the platform for round off. That is either hundreds, they can prepare financial statement in hundreds or thousands or lakhs or millions. They can't round off in crores. Right? If your total income is less than 100 crore, 100, thousands, lakhs, millions. These are the only 4 round off platforms available for such companies. However, if your total income is more than 100, is 100 crores or more. If your total income is 100 crores or more, then you can round off in lakhs, millions or crores. You can round off in lakhs, millions or crores or decimals thereof, like this. These are the round off provisions applicable. And once you choose a particular round off error, like suppose current year I have chosen to prepare my financial statement in crores. Why? Because my total income is 100 crores or more. So that means next year also I should prepare my financial statement in crores. Follow it consistently. 1 year crores, next year lakhs, next year millions. Don't keep hopping. One measurement basis whatever you have used. Round off measurement basis. Same thing consistently, uniformly try to follow year on year. That's all about this round off error. Comfortable are people? Everybody good? Yes, I've just written an example. Here, let's say a particular company ka total income is 80 crore. Then they can they round off? Can they present like this in financial statement? They say amount in crores and write 8. Can they do so? If your total income is less than 100 crore, you can round off only in hundreds, thousands, lakhs, millions. You can't round off in crores. You can only do it off maximum in millions. That's the maximum available for you. But if your company ka total income is 200 crores, then they can round off in lakhs, millions, crores of their choice. So here, can they do it in crores and just present 200 as value in financial statement? Yeah, this is acceptable. Because their total income is 100 crores or more. So rounding off in crores is acceptable for such companies. That's all about round off. Move on to the next. Next, we have, I think, 1 or 2 small concepts. Remaining are all questions based on that. If you want to break, I'll just tell you. How many? People, another 45 minutes more. Yeah, that's pretty much it today. I don't want to do anything beyond this today. That's enough for today. Okay. So if you want to take a small break and resume, I'm fine. That's okay. Or if you want to just finish off in one shot by 8:15, 8:20, 8 o'clock, I don't mind with that also. Your call. I'll leave it to your frame of mind. If you want to take a small break, about 10-15 minutes, I don't mind at all. Want a break? Yeah, we give me break. Oh, Palani is sticking to his normal dialogue. Sir, close. No, sir, I have audit, sir. Yeah. Audit over, no, Palani, no. No income tax is going on. No. Yeah. Sorry much. For this break, no, I give the precedence or preference to a face-to-face audience. Because Papa, they have to look at me, no. If they are feeling ayo, then I also can't look at them. So they are saying break, oh, so we'll take a break. How much time now? Same you just now talked about uniformity. You break also form uniformity. Okay, 7:45. Can we come back? All right, thank you.